Hello, good evening and welcome. I'm Karima Brown and you're watching Political Exchange, where we unpack Africa's political economy. The future of mines has come under intense scrutiny in recent months, following the debate in the African National Congress over whether or not to nationalise mines in South Africa. Last Wednesday, President Jacob Zuma again reiterated that the ANC had no plans to nationalise mines, despite the efforts by the ruling party's Youth League for a change in policy. So just what kind of policy change is on the cards? And in this all-important sector of the economy, who will be making the decisions? Joining me in studio to discuss the issue is one of the authors of the ANC's research report into the minerals sector, Paul Jordaan. Mr. Jordaan, thank you so much for joining us this evening. You've been responsible for what is called the state intervention into the minerals sector, the SIMS report. Just take us through some of the key recommendations around ownership. Nationalisation not on the cards.
Well, not quite. The report looked at the call coming, as you said, from the Youth League for blanket nationalisation. We did some calculations and this would have been impossible at market prices. We then looked at the Constitution, Section 25, and maybe it wouldn't be in market prices, but then we looked at the bilateral investment treaties that we have with most of the investing countries, or the countries where the investors are listed, and they demand prompt payment at full market price. We basically said it would be impossible, given the levels of debt that had gone up because of the US toxic debt crisis. Our national debt burden had gone up, and it would have cost more than the total expenditure.
But you are advocating for a radical or extreme makeover of the current, legislative framework. Take us through the most significant changes that SIMS is asking for.
SIMS took the view that, firstly, that minerals in the ground belong to the people as a whole. And secondly, that they are finite. As we well know in South Africa, from Stilfontein, Welkom, Kimberley itself, mines are a window of opportunity, mining, that opens and then shuts. And if that window is not used to optimize the impact of those minerals, the opportunity is therefore lost. We then said, well, what's best practice? And you were aware we visited 12 countries, but we also looked at maybe 50 countries in terms of what they had done, but we didn't visit them. And we came to the conclusion that the critical thing to do with a mineral endowment is to optimize the linkages. These are the economic linkages. And the 5 linkages that we felt were critical were: 1, the fiscal. And that is that minerals embody resource rents. Are these being captured? 1. And 2, are they being reinvested effectively for long-term competitiveness? The second was the backward linkages into mineral inputs, capital goods, supplies, consumables, etc. And we saw that successful countries had all developed those input industries and used that as a platform to industrialize. The next were the forward linkages, or what's known in South Africa as beneficiation, is adding value, not selling dirt, selling alloy, not selling alloy, maybe intermediate products, maybe then sub-assembled parts, or maybe finally, instead of iron ore, selling automobiles. And the next linkage, which through our research, we slowly realized is the most important, are the knowledge linkages. To what extent is the mining industry engendering human resource development, particularly technical skills, engineers, scientists, technicians, artisans, and then also technology development? To what extent are they catalyzing and supporting local technology development? What we call the knowledge linkages, we discovered were the most important, because there was pretty much 100% correlation between those that invested in technical skills and those that industrialized.
Let's go to
Sorry, the final one is the spatial linkages, is how you use minerals to put in infrastructure, rail, road, ports, telecoms, power, water, to underpin other sectors that will outlive mining.
Yeah. Now let's go back to the question of ownership. You've
Right.
already stated that wholesale nationalisation is simply unaffordable.
Mm-hmm.
What kind of models in terms of ownership are we looking at? I know that you've looked at the Botswana example, you've looked at Chile, you've looked at Finland. Are we talking about a greater equity stake for the state? At the policy conference, there were suggestions about a 30% stake. What exactly does SIM say about ownership?
Yeah, there are several things that you've touched on there. First of all, yes, blanket would be unaffordable. We then looked at best practice in terms of developmental states, or what are sometimes called command economies, and we found that it was the norm that certain minerals were under state ownership. And these are really the minerals that underpin jobs in terms of manufacturing. So what we did was we turned it around and said, just because we happen to have, say, ruthenium, therefore we need to beneficiate it to final, is a kind of a supply-driven approach. We took a demand-driven approach where we said, where are the jobs? We have, depends who you listen to, but late 20s or even up to 40% unemployment, depending by the definition. We need jobs. We're sitting on a time bomb. So we said, what are the critical mineral feedstocks into jobs? So we said for manufacturing, they're critically steel is the biggest globally, polymers is the second biggest globally, base metals, particularly copper. Then we looked at agriculture and its NPK, nitrogen, phosphate and potassium. Then we looked at infrastructure and it's again steel, cement, copper. And then energy, of course, are the energy minerals, your fossil fuels. We then said, are we getting those at internationally competitive prices? And of course, as you've seen in the press, we're not. The two most important feedstocks into manufacturing are both monopoly priced here. One by AMSA, the ex-ISCOR, and the other by Sasol. So we did say we have to get those prices. And we should try a variety of levers, but one, it could be they both are ex-national companies. Could be renationalisation, but there are other, competition commission. Maybe we need to reinforce the act to force them to stop monopoly pricing and so on. But there are a variety of levers, and what we've said is nationalisation is always one option. And the report says that it remains an option if other levers don't suffice. The state doesn't want to own everything.
It doesn't have the capacity to own everything. Doesn't have the
capacity, and the state would therefore only intervene really where there's no other way. But when we looked at developmental states that grew very rapidly like we need to grow, we didn't look at the states that grew in the 19th century, etc. We looked at states that have had recent miracles. They all had state steel, for instance. POSCO in Korea was state. Bao Steel in China is state. Taiwan was state. Finland was state. Sweden had state steel. And that was really to prime manufacturing to create those jobs.
Now, when one talks about those countries, what in your research showed, what was the reaction from commerce, from business in those countries? And are we likely to see, potential cooperation in South Africa? Because there's been nervousness about talks around nationalisation from the private sector here.
Well, as you're aware, the private sector itself has taken these monopoly people to court, as you know, and there have been judgments against them. So which private sector? So obviously all the consumers of steel would love to see the price of steel come down to a competitive level. Harmony took Mittal to court. They then did a deal or something. I don't know the details. So there's two sides to capital. Those that consume these obviously want competitive prices, and those that are monopoly pricing obviously want to continue monopoly pricing. So what's the reaction? In more developed countries, those state companies slowly became private. There's still a big state holding in, like Rautaruukki in Finland. POSCO is now pretty much owned by pension funds and that, but it was set up as a state company. So it's all about phasing. And the phase we're in these key feedstocks tended to either be under state control or with a lot of state influence in one way or another.
Now,
so we're saying, well, what's the outcome you want? You want competitive pricing. You want cheap feedstocks into your manufacturing sector to create jobs.
Yeah.
Nationalisation isn't an end point. It's a means to an end if you're going to nationalise. But there are many ways to skin that cat, which is what the report says.
Now, some in the business community have said that SIMS appear to not be aware of the intense negotiation that went into the current legislation that we have that governs mining in South Africa, and is somehow oblivious to the fact that, you know, that was quite a tense process. Do you share that criticism? Is that something that you were?
Well, of course, we're fully aware of it, and we were part of it, and some things were recommended at the time and didn't go in, like that part of the aims of the Act need to be the establishment of the linkages, not just dig a hole in the ground, but also to ensure that the up and downstream linkages and others that I've mentioned are made. You'd have to be specific. I mean, what are we not aware of?
Well, I think what business is trying to say is that, you know, there is an acknowledgement that the state has a role to play, but capital and private business can't be eroded, and there's fears that any changes in policy might, you know, weaken the scope for private enterprise and for private, you know, companies to participate in this sector.
Yeah, but from a state point of view, once we accept that ownership, which wasn't accepted in this country, we were the extreme case, which almost no countries in the world, of private ownership of minerals coming out of our colonial legacy and apartheid. That's an extreme case. You know, 90% of the world, minerals belong to the people, the nation, the crown, you know, or state or whatever. So that first MPRDA was around us normalizing. And of course, the industry kicked back, because what's nicer than having your own mineral rights in perpetuity? But that was completely untenable, given that we were now a democracy and these exclusive arrangements were not possible anymore that they had. The thing about being squeezed out or crowding out rather than crowding in, that's not the issue. The issue is minerals belong to the people. The state is the guardian. The state doesn't own the minerals. The poorest South African in the rural area or in a township, unemployed, theoretically owns 1/50,000,000th, if there are 50 million of us, of those minerals. So how do we govern them in a way that optimizes the positive developmental impact on our people? And therefore, if the private sector isn't doing that with particular minerals, then the state has a duty to intervene. I'm not saying to nationalise necessarily, but to intervene in some way or another.
Okay, Paul, let's leave it there. We have to take a short break, but when we return, we continue our conversation with Paul Jordaan on the policy landscape of the mining sector in South Africa.